You are listening to the Businesstalk podcast. I am your host Deepak from India. It's a great honor to have Dr. Barry Eichengreen joins us as our esteemed guest on today's podcast. Dr. Barry Eichengreen is a distinguished American economist and economic historian, serving as the George C. Pardee and Helen N. Pardee Professor of Economics and Political Science at the University of California, Berkeley, where he has been a faculty member since 1987. He is also a research associate at the National Bureau of Economic Research and a research fellow at the Center for Economic Policy Research. In 1997-98, he was a senior policy advisor at the International Monetary Fund. He is a fellow of the American Academy of Arts and Sciences, the convener of the Bellagio Group of Academics and Economic Officials, and the chair of the Academic Advisory Committee of the Peterson Institute for International Economics. Professor Berry has held Guggenheim and Fulbright fellowships and has been a fellow at the Center for Advanced Study in the Behavioral Sciences and the Institute for Advanced Study, Berlin. Among his most celebrated works is the book Golden Fetters, The Gold Standards and the Great Depression, 1990-1939, published by Oxford University Press. A regular monthly columnist for Project Syndicate, he has impressive body of notable publications spanning his distinguished career, a complete list of which is available in the YouTube description. Dr. Berry has received the Economic History Association's Jonathan R.T. Hughes Prize for Excellence in Teaching, the UC Berkeley Social Science Division Distinguished Teaching Award, and an honorary doctorate from the American University in Paris. In this episode, Professor Barry Eichengreen explores his forthcoming book, Money Beyond Borders, Global Currencies from Croesus to Crypto. Let's not keep you waiting. Please join me in welcoming Professor Barry Eichengreen to the podcast. Professor Barry, thank you for graciously accepting our invitation. It's an honor and privilege to have you with us today.
It's nice to be with you, Deepak. Thank you for posting the cover of my new book behind you.
Thank you. Professor, your book traces 2,500 years of international currencies. What was the single most surprising discovery you made while researching this extraordinary journey from ancient coins to crypto?
So I don't know if I should characterize this discovery as surprising, but one thing that comes out from the long sweep of history is that financial arrangements and institutions, the institutions that support the use of currencies and coins across borders are always evolving. They're always changing from lumps of precious metal to the advent of coinage in ancient Lydia. It spread to Greece and then to Rome. After that, reel forward by 1,000 years or so, and you see the Florentines developing credit alongside coinage, where you can settle transactions without actually having to physically move precious metal across space. You see the standardization of those arrangements. Promissory notes become standardized bills of exchange in 16th century Italy and then 17th century Holland. You see the development of a modern money center in London at the end of the 18th century and beginning of the 19th, with dealers in bills of exchange, liquidity provider, and then lender of last resort in the Bank of England. And then in the 20th century, when the dollar definitively overtakes the pound sterling, you see the development of correspondent banking in New York, computerized foreign exchange market, and then electronic trading. So all of that is not exactly a straight line, but a historical line from very primitive coinage, currency, and payments all the way up to crypto, all of which raises the question, of course, of what is the future of the monetary and financial system, and what does it bode for the dollar?
Professor, you described Greek and Roman coins as the first true international currencies. What made them so universally accepted across borders, and what lessons does that hold for today?
Well, Greek and especially Roman coins. You found Roman coins all along the Silk Road, from India to Sri Lanka to China and Japan, although how they actually got to Japan is uncertain and disputed by historians. They were so widely used and widely accepted because they held their value for an extended period of time. So today we see international currencies rise and fall in a period of decades or at most a century. The pound sterling gained its international status at the beginning of the 19th century. By the middle of the 20th, it was toast, to use a technical financial term. The dollar rose to prominence in the mid 20th century, and people are wondering whether its final days are now drawing near as the dominant global currency. Greek and especially Roman coins circulated across borders, across continents for centuries, for 2, 3, 4 centuries. They held their value for 2 or 3 or 4 centuries, something that is relatively rare for a currency today. They were supported by political systems with checks and balances. The Roman Senate, made up of wealthy landholders and investors, if you will, monitored the operation of the mint and provided checks and balances that maintained the value of that standardized coin that was not debased or devalued over a long period of time. These were powerful trading powers backed by powerful militaries. So it was a combination of political preconditions, commercial prowess, and military security, if you will, to combine to give them their international currency status, their wide circulation over a period of centuries.
Professor, you call the Florentine gold florin the greenback of the Renaissance. What gave it their dominant status and what eventually caused its decline?
So the Florentines added finance to trade. They started out by sourcing and importing raw wool from the Netherlands and England. And eventually they developed multinational banking, if you will. Their great merchant houses established foreign branches that provided finance for these activities. And then from there, they branched into purely cross-border financial business, where they underwrote loans and provided financial services for kings and popes throughout Europe, if you will. So it was the Florentine status as financial innovators that gave their currency its important international status, such that it circulated throughout Europe, the Near East, and to an extent beyond. Again, backed by the fact that the city-state of Florence had a thriving economy based primarily in woolens, but also in silks and other goods. And they had a relatively robust military supported by this thriving economy. In the longer run, you could see, however, how a small city-state nestled in the hills of Tuscany could not compete with larger, more powerful maritime powers. Florence didn't have ready access to the seas, couldn't compete with regional economies that could support more trade and more powerful militaries. So Florence eventually went into economic decline. It was overpowered by larger militaries from larger economies, and eventually its currency was overtaken as an international unit by those of these larger economies, starting by that of uh, the Low Countries, the Netherlands.
Professor, the British pound dominated the 19th century global economy. Was its rise more of a product of economic strength, political power, or simply historical accident?
As is often the case in economic and financial history, there was an element of each of the factors you describe. So, political power or political security, um, Britain was an island off the coast of Northwest Europe. It had the natural insulation that the Channel provided. So when the French invaded the Netherlands and occupied Amsterdam, leading to the demise of the Dutch guilder as the leading international currency, they found it much more difficult to invade and conquer Britain. So Napoleon contemplated the possibility repeatedly. He never pulled it off. So that natural insulation was one factor. Um, the Industrial Revolution obviously was a second. England and Wales um, uh, were where the Industrial Revolution began. Britain had the largest economy in the world for a period before it was overtaken by the United States. It had the most powerful manufacturing industries that supported extensive foreign trade, where Britain was the leading exporting nation for more or less the entirety of the 19th century. And that exporting and industrial prowess supported a powerful navy. Britannia ruled the waves. Britain, as you will well know from your own history, was able to conquer other lands, acquire colonies, which further supported the development of its economy. And finally, financial innovation, which is where I came in. The first thing that we began by discussing in our uh, podcast was an important support for the pound sterling as the leading global currency, that foreign banks set up shop in London. London banks started originating business abroad. There was this diverse ecosystem of brokers and dealers and bills of exchange, underwriters of foreign bonds, insurance companies that did international business. All of that made London the leading money center and the pound sterling the logical vehicle for cross-border transactions. That Britain was such an extensive trader made the pound sterling the logical currency in which to make trade-related payments. And finally, the Glorious Revolution and the fact that there was a parliament to impose checks and balances, if you will, on the king meant that the stability and security of the pound sterling were basically unquestioned from the end of the French and Napoleonic Wars, 1821, all the way up to the outbreak of World War I, 1914. So there were I started with political and military preconditions, mentioned Britain's rise as a trading power and an industrial power, and ended where I started with political and military preconditions. So none of that is a historical accident, but it was a combination of historical circumstances, none of which was predetermined. History could have turned out differently, but it turned out in such a way that there were uh, wide, there was a combination of different supports for the dominance of the pound sterling for a century and more.
Professor, you explained how the US dollar rose to the top during World War II. Do you think that dominance was inevitable, or was it a unique convergence of circumstances unlikely to be repeated?
In the book, I describe how the dollar rose to prominence really in two stages. First, after World War I, and then definitively after World War II. So World War I was a serious challenge to the incumbent, the pound sterling. Britain emerged from World War I weaker, and the United States had created the Federal Reserve System in 1914, one of whose purposes was expressly to internationalize the dollar to promote its more widespread international use. So U.S. exporters would no longer have to go to London for trade credit to support their exports. And the dollar did mount a challenge to the pound sterling in the 1920s. The two currencies were more or less co-equals from the end of World War I until the Great Depression of the 1930s. But then the U.S. suffered three major banking and financial crises, and the dollar fell out of fashion. Foreign central banks that had been holding dollar reserves alongside their sterling reserves liquidated those dollar reserves. The dollar was seen as unreliable until World War II, the Bretton Woods Conference, which was held while the war was still raging, and the Bretton Woods Agreement, which gave the dollar special status alongside gold as the only truly convertible currency that was held as reserves and used in making payments around the world. Was the Bretton Woods Conference, the Bretton Woods Agreement, a historical accident? No, because the United States was far and away the leading industrial power during and coming out of the Second World War, because the U.S. had learned lessons about the importance of maintaining financial stability. It did so more successfully after World War II than it had in the 1930s, and it recognized the need to provide the global public good of a convertible currency that could be used to support the reconstruction of global trade after World War II. So now we are in the peculiar situation, I think we may come to this in a few minutes, where the Trump administration denies the need for the United States to provide global public goods. It denies the need of the United States to provide security through the NATO alliance, although it may think it's providing a form of security through its war, through its adventures in the Middle East. The Trump administration denies the need for the United States to provide a global currency in the form of the global dollar. After World War II, U.S. policymakers recognized that need, and they acted successfully on it. So your question was the rise of the global dollar as the top currency during and after World War II inevitable? I think there was an element of inevitability. The United States was the largest and most powerful economy in the world, by far the leading trader, but there was also a unique convergence of circumstances in that the U.S. recognized its global responsibilities and acted on them. Not all U.S. administrations, past and present, have recognized those responsibilities and acted on them.
Professor, since the 1970s, experts have repeatedly predicted the dollar's decline, yet it has survived. What has kept it resilient for so long despite these repeated predictions of its demise?
Two things. Number one, U.S. economic policy has been tolerably good. Hasn't been perfect. We've had our problems in the United States from uh, the stock market crash in 1987 to the global financial crisis and subprime crisis of 2007, 2008. But aside from a dangerous spike of inflation at the end of the 1970s, a problem that Paul Volcker and the Fed corrected, and some episodes of financial mismanagement like the subprime crisis, central banks, governments, firms, commercial banks around the world have been okay about continuing to hold and use dollars, hold dollars as reserves, use dollars in payments, allow the dollar to be the vehicle for their international investment. So tolerably decent policy on the part of the U.S. that the U.S. is not exploited to its own advantage, the leverage that it enjoys as a result of the dollar being the global currency. So since the turn of the 21st century, we have seen the United States taking increasing recourse to financial sanctions. We have seen people talk and worry about American weaponization of the dollar. So that situation where the U.S. has provided a reliable public good and not exploited the financial leverage it derives from the dollar's global status may be changing. And third, the fact that there's been no alternative at scale. The euro has not been attractive because there has been a shortage of AAA rated safe sovereign bonds denominated in euros. There's no euro area treasury. Capital markets union in Europe is still a work in progress. And the Chinese renminbi is still the currency of an economy that is not fully financially open to the rest of the world, that is starting out very far behind the United States in the global currency race. So one wonders whether all of those circumstances that have held the dollar securely in place as the leading global currency, the fact that U.S. economic and financial management has been tolerably good, the fact that the U.S. has resisted the temptation to weaponize the dollar, and the fact that there has been no alternative at scale until now, one wonders whether all three factors may be in the process of changing. That's what my book is about.
Professor, your book makes a powerful case that the dollar is now on the downside of its dominant cycle. What are the key warning signs you see today that suggest this transition is already underway?
Well, we see and hear policymakers around the world, corporate treasurers around the world, trying to hedge their dollar exposure, looking around for all alternative forms in which to hold reserves and make cross-border payments. Until now, there have not been a lot of other forms. So we have seen so far more looking around, more talk about possible alternatives than we have seen actual movement. But we are seeing important central banks trimming their exposure to U.S. Treasury bills and bonds. We have seen movement by central banks of emerging markets into gold as a hedge against global financial risk and as an alternative to holding dollars. So vaulting gold at home is not a perfect substitute for dollars. Gold vaulted at home cannot easily be used in financial transactions. It can't be lent. It can't be used as collateral for those purposes. It has to be held in New York at the New York Fed or in London at the London Metal Exchange or Bank of England, which reintroduces an element of risk. But we are seeing movement in that direction, and we are seeing some signs of the dollar's traditional safe haven status beginning to break down. So on Liberation Day in April, when the VIX spiked, normal historical behavior would be that there would have been flight into dollars because the dollar is a safe haven. The U.S. Treasury market is the single biggest and most liquid financial market in the world. We didn't see that movement into the dollar. We saw movement out. So I think all of those are signs that maybe the dollar's traditional safe haven character and position at the center of the global monetary and financial system is beginning to break down.
Professor, you bring the story all the way to cryptocurrencies and central bank digital currencies. Do you see them as a genuine contenders to replace the dollar, or are they more of a complementary force in the global monetary system?
As you and I talked about at the beginning of the podcast, financial technology is changing continuously, has continued to evolve over the course of 2 and more centuries now. And I see what's going on in the digital sphere as further evolution of that system. I think what is clear is that distributed ledger technology the blockchain, if you will, is a significant new set of payments rails, especially for cross-border transactions, where old-fashioned traditional correspondent banking and SWIFT and the dollar, as they have functioned until now, are clunky. They're very inconvenient, slow, and costly for international transactions, where you can do similar transactions on a blockchain in a matter of seconds at much lower cost. So I think those payment rails, or that new form of digital plumbing, are a significant new contender to complement and possibly provide a real alternative to New York-based correspondent banking, the dollar, and SWIFT. What will run on those payments rails, on the other hand, is not so clear. I don't think it will be plain vanilla cryptos like Bitcoin, because they're too volatile. They don't provide the means of payment, store of value function that we expect of money. I don't think it's going to be stable coins, which would, were they a contender, they would work to the dollar's advantage, because 99% of stablecoins out there at the moment are dollar linked. That would give the dollar a leg up or more staying power, but their stability is yet to be proven. And I think the arrow of history points in the other direction, away from private monies, which are what stablecoins would be, towards the state providing this public good we call stable money. So the contenders, to my mind, are two: digital representations of central bank money, central bank digital currencies, or tokenized bank deposits, digital representations of commercial bank money. So the advantages of those is that they can exist within the currently prevailing regulatory framework. Adopting them is not a big challenge for business either. I think they are coming, and they will allow businesses and governments of different countries to do business with one another directly without having to go through the dollar and correspondent banks and SWIFT as they do now. They can securely and quickly someday do that business using these tokens on either a public or a private blockchain. We will see which one it's going to be, and I think that will pose a challenge to the dominance of the dollar going forward. Firms and banks residing in different countries will be able to do business directly with one another using this new set of digital payment rails.
Professor, when the world eventually moves away from dollar dominance, who do you think will be the biggest winners, and who will bear the heaviest cost of the transition?
I think the world will be a safer place when we finally get to a more multipolar, decentralized international monetary and financial system that doesn't rely as heavily as we rely now on the common senses and goodwill of one government, that of the United States. So up until now, the U.S. has recognized that America benefits and the world benefits from provision of a stable unit, the U.S. dollar, that can be used as an international unit of account, an international store of value, an international means of payment. But I worry about the reliability of this U.S. government and perhaps future U.S. governments to continue to provide that global public good. So in the same way that the world is a better place with a diverse ecosystem that is robust to shocks to individual regions or parts of the ecology, I think it will be a safer place with a diverse international monetary and financial system where other central banks and governments and countries can step up and provide the global liquidity needed by 21st century globalization if the U.S. falls down on the job. And that's a picture where the United States suffers the negative consequences. We derive benefits from the global dollar. We are able to borrow more cheaply than we would be able to otherwise. We have the advantage of being able to do cross-border business in our own native currency. And I fear that we could squander those benefits.
Professor, I would like to conclude this episode with one last question. If you were to advise policymakers in Washington today, based on the 2,500-year history you have chronicled, what is the single most important lesson they must heed to either preserve or gracefully manage the dollar's global role?
The dollar's global role rests on three things, I would tell them. Number one, economic and financial stability, which are not to be taken for granted. Number two, a division of powers and checks and balances that limit arbitrary action by the prime minister or the president or the executive branch that give international users of the dollar confidence that its stability will be respected. And number three, good relations with foreign powers, alliance politics. Government central banks firms hold and use the currencies of their alliance partners because they see those alliance partners as reliable stewards of their reserve holdings. They like to hold the currencies of their alliance partners as a show of good faith toward those partners. So this government, or more likely a future U.S. administration, will be able to cement the dollar's international role or manage its gradual decline gracefully if they maintain that economic and financial stability, they respect those checks and balances, and they uphold U.S. alliances. So you will know that from this way of framing things, that the conclusion of the book is not very optimistic about the immediate prospects for the global dollar. But I am an optimist. I'm a believer, patriotic believer in my country. So I hope there will be a future administration that will see the importance of those policies and that will pursue them.
Thank you, Professor Barry Eichengreen, for sharing your insights on money beyond borders, global currencies, from Croesus to crypto. Your perspectives on exchange rate, capital flows, and international finance have given our listeners much to think about. We truly appreciate your time, your kindness, and expertise on today's episode. Thank you so much.
Thank you, Deepak.